Downbeat economic data on the US released last week enabled a slump in risky assets. Weak non-farm payrolls and soaring unemployment raised concerns about whether the Fed Reserve can provide a soft landing for the world's largest economy. All in all, markets closed last week on a pessimistic note due to economic fears, escalating tensions in the Middle East, and concern about the poor earnings of high-tech giants. Importantly, everyone expected sluggish employment in the US labor market, but no one, even in a nightmare, could have imagined what actually happened. First of all, we are talking about the unemployment rate, which jumped from 4.1% to 4.3%, although analysts had expected it to remain flat. In addition, the number of new jobs in July was only 114,000 instead of the estimated 190. Moreover, previous data for June were also revised for the worse, 179,000 compared to 206,000 previously. Last but not least, wage growth also slowed down lower than predicted. It was steady, 3.6% in July, and became the lowest since May 2021. All these metrics suggest that the US economy is suffering from the high interest rates of the monetary regulator, before the mass media rushed to draw gloomy forecasts and predict that there will be no soft landing of the American economy. On the contrary, this state of affairs indicates a looming deep recession. Analysts assume that the Fed Reserve is to blame for economic malaise in the US because the central bank delayed too long before starting monetary easing. There were also rumors that on September 18, the key interest rate would be lowered by half a percentage point. According to the Fed Watch tool, 95.5% of the market already allows this possibility. On a Friday before non-farm's publication, this figure was only 27.5%. The prospect of a sharp rate cut is bearish for the US dollar, so the greenback took a nosedive. If the looming slowdown of the American economy accelerates, the Fed Reserve will have a little leeway to stem the process over the next months and a half. In the meantime, the US dollar has begun to work off future losses now. Its index is trading lower in the intraday corridor of 102.20 to 103.20. This is only the beginning of a future, even greater decline in the American currency. The recession risk in the world's top economy also harmed stock prices. Stock markets crashed around the world. The American leading index S&P 500 tumbled by almost 140 points from August 1st to 2nd. On a Monday, it also remained in the red zone inside the corridor of 5,302 to 5,384. The euro-dollar pair commonly trades in sync with the Wall Street benchmark stock index, the S&P 500. In this context, the greenback acts as a safe haven, but the single European currency is a risky asset. The situation now looks confusing, and the US dollar found itself in the position of an unreliable investment instrument. So, amid the economic calendar and the news flow from the United States, traders added long positions on the euro-dollar pair. As a result, the instrument almost completely recovered after the recent corrective move. The currency pair traded higher in the first half of a Monday within the range of 1.0897 to 1.0977. At the same time, from the point of a technical analysis, the euro found itself in an overbought position. Hence, a pullback was quite expected. As for the further growth, first, the euro-dollar pair has to update the high of July. Only this condition, the euro bulls will be able to enable a breakdown of the psychological level of 1.10. But judging by the statistics released today, the Eurozone economy is not ready yet to actively support its currency. The Composite Business Activity Index for the Eurozone published a few hours ago was slightly upgraded. It now stands at 50.2, an uptick higher than the preliminary 50.1 points. Crude oil continues to trade weirdly. Despite the massive fall in the US dollar, oil is still losing in value. The price has already dropped to the lowest level since the beginning of the year. On the top of that, this is happening amid escalating tensions in the Middle East. In addition, the mounting panic in the global markets caused by concerns about the prospects for the US economy and should influence oil sooner or later. In turn, oil prices will have to begin a correction. But so far, contrary to the news flow, Brent futures are sliding within the intraday corridor between $75 and $77.80 per barrel. Most likely sell-offs in the market were triggered by speculators. In this situation, everything points to an imminent correction. However, traders should be extremely careful since inertia is still relevant and speculators are making good use of it. The Russian ruble remains stable, and the dollar-ruble pair is trading in an intraday corridor from 85 to 86. However, the sharp drop in oil prices will inevitably have a negative impact on the Russian currency. That's why the currency pair will shift to a higher range between 86 and 87 in the near future. So that's all for today. We wish you profitable deals and see you on our channel with a new video tomorrow. Gold is extending its rally amid market turbulence. It looks like investors once again decided to follow the old rule: when the market falls, take what shines.